Hi there. This is the class test for the year 2013 that I will be recording in this short video. And in this class test, we had question 1 that was out of 30 marks. Then after it read as follows. You are provided with the following trial balance on the 31st of July 2013, being the last day of the financial year. So now that tells us that the end of the accounting period is the 31st of July each and every year. That means the accounting period begins on the 1st of August each and every year. Because if it ends in July, it starts one day after, and that one day after will be the 1st of July each and every year, being the beginning of the accounting period for this exercise. Therefore, now it says before the trial balance for rent a cab as at 31st of July 2013. So now we are given the trial balance, and in the trial balance I will only highlight few items that are critical for asset disposal topic and the property, plant and equipment note. So now we are given assets, and one of the assets is equipment and other. That means the total of 120 is not only one equipment, but it's equipment C and other equipment. Then the second asset that we have is vehicles, which is made of vehicle Y and other vehicle, and the total is 150,000 rands. Then after we are given the cost of the land and building amounting to 100,000 rands. After that, we are given the accumulated depreciations for equipment on the 1st of August in the year 2012. That means this is an opening balance of all the depreciation for equipment from the date the equipment were acquired until the end of the year 2012. Therefore, now it begins in the year 2012 again, which is the 2013 accounting period. And the total accumulated depreciation is 9,500. I always highlight that it's important that students should be able to calculate this amount. However, I will not prove that in this exercise. Then we are given accumulated depreciation for our vehicles, and it's also on the 1st of August in the year 2012, indicating that the amount of accumulated depreciation opening balance for beginning the year 2012 for 15,000 is for our vehicles. Therefore, now that will be recorded as an opening balance when we do the ledger account. So now if you see here, we have three assets. The first asset is equipment, second asset is vehicle, third asset is land and building. And now for the two assets, which is equipment, there was accumulated depreciation, and for the second asset being vehicles, there was accumulated depreciation. However, for the land, we don't have land and building, we don't have accumulated depreciation. That should indicate that land and building does not depreciate, but we don't know about that as per yet. But most of the times, land and building does not depreciate. So now I'll just skip all other items that are in the trial balance, as they are not so much important more than the three assets and the accumulated depreciations that I have identified for the two assets being equipment and vehicle. So now let us scroll to the information below the trial balance in this exercise. Below there it says the following additional information is provided to you. Then after it says depreciation. So now this information is with regard to the depreciation of our assets. The first asset is a vehicle, where it says all vehicles are depreciated at 15% per annum on the reducing balance method, or on the so-called diminishing balance method. So now all the vehicles are depreciated using a diminishing or reducing balance method. Second says on the all equipment is depreciated at 10% per annum on the straight line method. That means the depreciation on equipment is calculated using 10% on a straight line method of depreciation. Next one is says land and buildings are not depreciated. That is why now in the trial balance there was no accumulated depreciation for land and building. Now let us continue further reading in this exercise. Movements throughout the year. That means these are the transactions that occur or that took place during the current financial year. The first movement says on the 1st of September, 1st of September in the year 2012, a new vehicle, which is vehicle Y, was purchased to the amount of 50,000 rands and already included in the balance of vehicles in the trial balance. So now this new vehicle, that is vehicle Y, bought on the 1st of September at a cost of 50,000 is already included in the amounts of our vehicles in the trial balance. Let us check our vehicles in the trial balance. Under the trial balance, we have an amount of vehicles which is a total of 150,000 rands. So now that means the 50,000 of the vehicle being vehicle Y is already included there. That means this 150,000 rands is not the opening balance in the beginning of the year, but it already includes the purchase of vehicle Y amounting to 50,000 that was bought during the year. So now it means the opening balance of vehicles will be 150,000 minus 50,000 being vehicle Y purchased during the year. That will give us an amount of 100,000 rands as the opening balance of our vehicles in the beginning of the current accounting period. So now we can continue with that. That was the adjustment regarding the purchase of the vehicle on the 1st of September 2012. Now to highlight another very critical thing regarding this vehicle. This vehicle was purchased on the 1st of September in the year 2012. That means we have to account for the number of months we held this vehicle or we had this vehicle until the end of the current financial accounting period. So now we'll do that when we deal with the depreciation side of the transaction. Then the next sentence says depreciation on vehicles for the current financial year has not yet been recorded. So now we have to account for the depreciation for the number of months we had vehicle Y from September until 31st of July 2013. So now when we count the number of months, it will be September. Why do we include September? It's because the motor vehicle was acquired on the first day of September, beginning of the month of September. So now we have to include the full month because the asset was there for the full month of September. So now when we do our calculations, we have to say September, October, November, December, January, February, March, April, May, June, July. Therefore now the depreciation for this vehicle in the year 2013 will be 11 months or accounted for a period of 11 months from September until July 2013. So now this was the first adjustments or the first movement that occurred throughout the current year or that occurred during the year. The second adjustment says included in the equipment. That means in the amount of equipment in the trial balance. Included in the equipment is an amount of 25,000 rands, which represents equipment C, which was purchased on the 31st of April 2013. Remember, the accounting period ends 31st July each and every year. So now if this equipment was bought at the end of April, therefore now when you calculate depreciation for the year 2013, it must be May, June, July, which will be 3 months. So now we are told that equipment C that was bought during the year costing 25,000 rands is already included in the amount of the equipment that sit in the trial balance. Let us go and check how much is the total of our equipment. Our equipment says 120,000 rands and is made of equipment C and other That means it's not one equipment. And we are told that the 25,000 rands of the equipment that was bought during the current year is already included here. So now we have to remove that 25,000 so that we are left with 95,000 rands of the value of equipment that was in the business in the beginning of the year. Therefore, now the opening balance of equipment in the beginning of the year will be an amount of 95,000 rands, excluding 25,000 of the cost of equipment that was acquired by the end of the month of April in the year 2013. So now we'll also account for that when we do the ledger account for equipment, and also account for the depreciation only for 3 months when we do the depreciation in this transaction. The third dot says on the 31st of July, which is the end of the accounting period, because the year end is 31st July. This was the end of the year. On the 31st of July, old equipment which was in the business since the 1st of August 2011 with the cost price of 95,000. Do you see this 95,000? When we set 120,000 rands and we subtracted 25,000 rands here, we set minus 25,000 rands, that gave us 95,000 rands. And we know that 95,000 rands is the old equipment that was in the business before the beginning of the current year. So now they are telling us that this equipment is the one that is the old one and it was sold by the end of the current year. So now we have to calculate the depreciation for this equipment for the current year and also calculate accumulated depreciation for this equipment from the year it was bought or from the year it was acquired, being the 1st of August in the year 2011. Then after we have to take into consideration the disposal of this asset. Then we have to remove the total accumulated depreciation and remove the cost from our books. Then after we will be done with the removing of this asset from the books of the business. It further continues by saying that it was sold on credit to Mr. C. Olector for an amount of 50,000 rands. And they further say no interest regarding this transaction has been made as of yet. So now depreciation was not yet taken into account. And if you see the consistency in all these three transactions, it said here depreciation on vehicles for the current financial year has not yet been recorded. So now we need to account for depreciation for the current year here. Second dot, if you see, if I can number this. Second dot, second sentence says depreciation on equipment for the current financial year has not yet been recorded. So now current year depreciation in the two was not yet accounted for. And again in the third bullet it says no interest regarding this transaction has been made of yet. So now it means the disposal of this equipment, being the old equipment, was not yet accounted in the books of the business. So now there is quite a whole lot of transactions that we have to account for during the current financial period. Number 4 says that interest expense is paid for 9 months only. That means in the internal balance there is interest that has been paid already, but the interest is only paid for a period of 9 months, and we know that it is supposed to be a period of 12 months. So now that will tell us that there is accrued interest expense that has not, or interest that has not yet been paid, which is a liability by the end of the current year, only a 3 months interest. So now we have to divide that by 9 months, then that will give us an interest for, or an interest per month. Then after we have to multiply that by the number of months, which is 3 months. And if we say 22,500 divide by 9, that will give us an amount of 2,500 rands, and we times that by 3, it will give us the amount of the interest that is accrued. So now we times that by 3, that will give us 7,000 rands 500. 7,500 rands. So that will be accrued interest expense. When we do that, I will just repeat it to you again when we go to the requirement for that interest. Now let me just go to what is required and check what we can do. 1.1 says we must provide for all relevant transactions. That means for all the transactions that are above, for all relevant transactions in the general journal for the year ended 31st of July 2013. So now we are required to do all the relevant general entries. Remember, in the first bullet point, we were told, in this first bullet point, we were told that motor vehicle Y was purchased and the cost for that was 50,000 rands, and that was already accounted for or included in the balance of vehicles in the trial balance. That means it was recorded. The purchase of this vehicle, being vehicle Y, was already recorded. However, they told us in the second sentence that vehicle Y's depreciation, or sorry, depreciation on vehicles for the current financial year has not yet been accounted for. So now we only need to account for the depreciation for the vehicle. So now the first journal entry that we need to do is the journal entry for the depreciation for vehicles. And if you see that they say vehicles, to indicate that it's the old vehicles that we had and it's the new vehicle that was acquired on the 1st of September in the year 2012. So now we'll do a journal entry for that. And in the second adjustment, they told us that there was also an equipment that was costing 25,000 rands that was acquired during the year, and that equipment was equipment C. And they said after that, depreciation on equipment for the current financial year has not yet been accounted for. So now the minute they told us that 25,000 is already included in the trial balance, included in the equipment, which means in the trial balance, it means the cost of this equipment that is 25,000 rands was already recorded, and it was recorded correct. But the only thing that we need to account for is the depreciation on equipment on the current financial period for all the equipments, the new equipment and the old equipment that is in the business. Then the third one, so now is the depreciation for the vehicles. Then after the depreciation for the equipment, then the third one now, it was the disposal of the old equipment. It was the disposal of the old equipment. We sold the old equipment at a price of 50,000 rands. So now all the entries that would affect your ledger account of the asset disposal, all the journal entries that would affect the accumulated depreciation ledger account for the disposal of the asset, and all the entries that would affect the asset being equipment when you dispose that equipment in the ledger account for equipment will have to be done, but in the form of general journal. So now we'll do the same thing that we used to do in the ledger account, but we record it in the general journal point of view. Then after, we'll have to account for the interest that was accrued, and it amounted to 7,500 only for 3 months. That was not yet paid by the end of the year. So now these are the general journal entries that I will be accounted for. But let me just take it from the direction that I always recommend students to use, where we start with the ledger accounts. Then after, we transfer that information from ledger account into the general journal. And that approach for me, I think, is just the easiest approach, unless you are already you already understand the subject very well. Then if you are fine with that, you can go straight to general interest. But if you are not comfortable with that, please start doing the ledger account as your workings. Then after, you transfer that information into the general journal. So now I will just start with my ledger account, and starting with my ledger account, I will do the ledger account for vehicles. Then I'll do the ledger account for accumulated depreciation on vehicles. Then after, I will stop there because motor vehicles were not disposed. Then after, I'll take the same information, then we'll transfer that in the general journal. So now let me begin with the ledger account for vehicles at the cost price. So now just to write the name of the exercise on top of this heading. So now this is class test for the year 2013. Class test 2013 is the year. So now I start with the ledger account for vehicles, and we know that vehicles, or a vehicle, is an asset, and any asset is increasing on the debit side, and assets like vehicles always have an opening balance on the debit side. It always does not change. So now the opening balance of the motor vehicles will be an amount of, let us check. Our vehicles amount to how much? To an amount of 150,000 rands. But remember, we subtracted 50,000 rands for vehicle Y. Vehicle Y that was acquired during the current financial year. Because in the adjustment, we were told that on the 1st of September, there was a new vehicle that was costing 50,000 rands, and it was bought during the current financial year. And they said this 50,000 is already included in the trial balance. So now it means the amount of vehicles in the trial balance of 150,000 rands is not the opening balance. We have to separate that. We record 100,000 rands only as an opening balance, that 100,000 rands. Then after, we record 50,000 rands as the purchase of the vehicle during the current financial period. So now we record that as an opening balance of 100,000 rands. Therefore, now we don't know if the vehicle that is costing 50,000, if was it bought for cash or credit. So now hence it's better we say bank/credit. Then we record that 50,000 rands of a purchase of the vehicle. And there was no further purchase of the vehicle during the current accounting period. So now from there we can just close off this account. Remember, there was no disposal of vehicle. So now if there was no vehicle that was disposed or sold during the year, then we can just balance our ledger account. And the bigger side is obviously 150,000 rands being the debit side. Then after, we write that as a balance carried down on the credit side. Balance carried down 150,000 rands, and 150,000 rands being a balance brought down. Balance brought down. So now remember, when we do the PPE note, okay, let me add a 0 there and 100,000. Okay, all my zeros now are correct. So now when we do the PPE note, this opening balance of 100,000 will be an opening balance in the PPE note. And this 50,000 will be a movement or purchase during the year. And the closing balance of the motor vehicles in the PPE note must be 150,000 rands. Because what I reflect on the ledger account must, in terms of opening balance and the closing balance, must exactly be the same as it reflects in the PPE note. Then after, we do the second ledger account, which is accumulated depreciation for motor vehicles. So now we write that as accumulated depreciation for our motor vehicles. And remember, this ledger account always has an opening balance on the credit side. MV is just a shortcut for motor vehicles. This ledger account always has an opening balance on the credit side. So now that does not change all the time. And our accumulated depreciation has an opening balance on the credit side, and the one for vehicles is given to be 9,500. Accumulated, accumulated depreciation for vehicles is 15,000 rands. 9.5 is for the equipment. So now we have to record that as an opening balance, 15,000 rands. So now we record that 15,000 rands on the credit side. Then after, we have to record depreciation during the current financial period. So now we first have to check how much is the cost of our vehicles. We know that cost of our vehicles is 150,000 rands in total, and we know that out of that 50,000 is for the new vehicles. So now we have to come to the adjustment and check. Okay, we have two vehicles now, vehicle Y and other. Vehicle Y, remember, it was acquired 1st of September, and other vehicle was there before the beginning of the current accounting period. So now it means we have to calculate our depreciation for vehicle Y first for the current year, because vehicle Y was not there before the current year. So now let us calculate depreciation for vehicle Y, and we say depreciation for motor vehicle Y. And we know that vehicle Y was acquired in the year 2013. Remember, in the information given, they say in the year 2012. But remember, the 1st of September is during the accounting period that ends 31st of July 2013. So now hence I write that as 2013, because the accounting period that ended 31st of July 2013 started on the 1st of August in the year 2012. So now anything that took place in the year 2012 after July, it was for the 2013 accounting period. Hence now the depreciation will be for the year 2013. We know that the cost of vehicle A is 50,000 rands minus accumulated depreciation. There is no accumulated depreciation for vehicle Y in the year 2013 because it was just acquired in the current accounting period. Therefore, now our depreciable amount will be 50,000 rands, and we times that by 15% because our vehicles are depreciating at 15%. So now we'll say 50,000 rands times by 15%, and that will give us a depreciation of 7,500 rands. Remember, this is a depreciation for the full year because 15% is per annum. As you can see that it is written PA representing or a shortcut for per annum. So now we only need depreciation for the number of months we had this vehicle in the business. Remember, vehicle Y was acquired 1st September, therefore we said September, October, November, December, January, February, March, April, May, June, July, August, September. Sorry, June, July. Yes, so we end in July the following year. Let me count once again. September, October, November, December, January, February, March, April, May, June, July. So now it's only 11 months. Hence, we have to multiply that by 11 over 12. Then that will give us a depreciation for only 11 months in the current accounting period for vehicle Y. And that gives me 6,875 rands. So now I can just immediately go and record the depreciation for the current year for motor vehicle Y. Depreciation, I was just open brackets here, 6,875, because there's still another depreciation that is coming for the old vehicle that was in the business before the purchase of the new vehicle. So now we've accounted for depreciation for motor vehicle Y, and remember the old vehicle is valued, or it cost an amount of 100,000 rands. Let me just delete that now. So now we know that 50,000 is included for the new vehicle, and the old vehicle is costing 100,000 rands, and the accumulated depreciation that we have here of an amount of 15,000 rands is only for the old vehicle because it's an opening balance. So now on the 1st of August, remember 1st of August 2012, motor vehicle Y was not yet there, and we are told that the depreciation for the current accounting period has not yet been recorded or has not yet been accounted for. Where do I get that? It's from this adjustment. They said depreciation for the current year on vehicles has not yet been accounted for. So now it means the depreciation for the new vehicle is not yet included in that accumulated depreciation, obviously on the 1st of August. So now hence I can boldly say this 15,000 is the accumulated depreciation only for the old remaining vehicles. So now let me calculate the depreciation for the so-called old vehicles. So now I will be calculating depreciation for the old vehicles for the year 2013. Depreciation for the old vehicle, or for the other vehicles for the current year 2013. So now I know that the cost of the old vehicles is 100,000 minus accumulated depreciation of 15,000, and that will give me an amount of 85,000 rands. Then it was there for the full year. For first, we first have to multiply by 15% to get to the depreciation for the year. So 85,000 rands times by 15% will give us 12,750 rands. So now that is the depreciation for the current financial period for the old vehicle that was in the business before the current period. Then that will be 12,750 rands, which means the total depreciation will be 12,750 plus 6,875, and that will give us 19,625 rands as the total depreciation for the two assets that we had. Now remember once again that there was no disposal of a vehicle. So now if there's no disposal of a vehicle, you record the opening accumulated depreciation and you record depreciations for your assets, in this case being vehicles, up to the end of the year. Then you just balance the ledger account from there, because there was no new vehicle that was acquired during the current accounting period. So now let me just balance this ledger account, and obviously the bigger side will be the credit side. So now I just have to add my credit side. That will give me 34,625 francs, 34,625 francs, and the balance carried down will still be the same, 34,625 francs, 34,625 francs, and this becomes the balance brought down. So now this is the closing balance. We need not to forget that. And this 15,000 was an opening balance. So if this is an opening balance, when we do the property, plant and equipment note, opening balance must be 15,000 and the closing balance must be 34,625 of the accumulated depreciation for vehicles in the PPE note. So that must still remain the same. So now let me just go to the new page where I will be tackling the ledger accounts for the equipment. Let me come and read all the transactions with regard or that affect my equipment ledger account. So now in the equipment, I know that we start on the second dot. In the equipment, we were told that there was equipment that was costing 25,000, which was purchased during the current year, and it is already included. Look there, the first word, included in the equipment. Included in the equipment, which tells us that in the total balance, 25,000 rands is already added there. Is the cost of equipment C, which was purchased on the 31st of April 2013. 2013. Remember, the end of the accounting period is July. Therefore, now depreciation will be for May, June, July. We need to account for this depreciation for this equipment only for 3 months. The second one, we're told that there was equipment that was sold during the current accounting period, and the cost for that equipment was 95,000 rands. And we were told under number 2 again that depreciation on equipment has not yet been accounted for, which is depreciation for the current financial year. So now we have to account for depreciation for the current year, and we're told under the third adjustment that no entry with regard to this transaction has been recorded as per yet, which indicate that the full disposal transaction or all the interests that affect the disposal of this asset are not yet accounted for. So now we have to account for all of that. So now let me go to my ledger accounts and do the 3 ledger accounts for equipment. I always have to start with the cost of the equipment. Then I record the ledger account on equipment at cost. Then I draw the line as usual. This is an asset account, so now an asset account will have a balance on the debit side, and the balance will be 95,000 rands. Why 95,000 rands becomes a balance? Because an amount of 25,000 rands is for the equipment that was bought during the year, and this 25,000 rands is already included in the cost of the equipment, as I have shown you there. 120,000 minus the new equipment 25,000 rands that was bought during the current year, then that will give us 95,000 rands as an opening balance. So now let me just move slowly, continuing with that point. So now that is why the opening balance is 95,000 rands. Then after we record the purchase of the new equipment, remember we were not required to re-record this, but I just want to take it back on how things were supposed to have been done. Therefore now we don't know either was it bank or creditors. Therefore now it will be an amount of 25,000. This is the new equipment that was bought during the year. So now you start with an opening balance and you record whatever happened during the year. Then after you dispose, if there was any disposal during the year, and I think there was a disposal of equipment, then we record that as asset disposal. And the equipment that was disposed during the year, they told us that it was costing 95,000 rands. As you can see in the third adjustment, that an old equipment that was costing 95,000 rands, which was in the business from the 1st of August in the year 2011, was sold out of the business. So now we have to remove that equipment at a cost price. That is why we record 95,000 rands. So now we know that there was no other disposal of equipment. Then if there was no any other disposal, we can just balance this ledger account. So now let us just draw the line to balance this account. Always draw 2 lines to balance the ledger account. So now we have to say 95,000 rands plus 25,000 rands. That will give us 120,000 rands, 120,000 rands. And 120,000 rands minus 95,000 rands will give us 25,000 rands, being the balance carried down, and 25,000 rands being the balance brought down. It means once again in the PPE note, the opening balance of equipment must be 95,000 rands, and the opening and the closing balance, at the bottom of the PPE note, being the closing balance, must give us 25,000 rands, because the cost of all the equipments that we had, it was 120,000 rands, but 95,000 value of equipment or cost of equipment was disposed, then hence the remainder becomes 25,000 rands. Then after I continue doing the second ledger account. The second ledger account is accumulated depreciation on equipment. So now this is where I have to account for all the depreciations for all these equipments. Then I start with the balance on the credit side, and the balance of the accumulated depreciation opening balance is from the trial balance, because in the trial balance we are told that the accumulated depreciation for equipment on the 1st of August is 9,500 rands. So now I record that 9,500 as an opening balance as it is stipulated, 9,500 rands. Then after I record depreciation for the current financial period, I record depreciation for the current financial period. So now I have to separate my depreciations in this instant, because there is a depreciation for the equipment that was sold and depreciation for the equipment that remained in the business until the end of the year. So now let us check if do we really have to separate the two or we don't have to separate the two. Now the equipment that was sold when? Let us check there under transaction number 3. They said on the 31st of July, which is the end of the accounting period. So now the depreciation was accounted at the end of the accounting period. So now we don't have to separate our depreciations. And they said included there, we have to account for the depreciation for this equipment that was acquired on the 31st of April. Let us start calculating first the depreciation for equipment C that was acquired on the 31st of April in the year 2013. So now we calculate depreciation for equipment C. Let me first save this part so that when we need it, it is available. So now let me just wrap that page. Okay, save first. Then we shall continue. Okay. So now I can wrap this part so that I have fresh and new workings for the equipment. However, don't worry, what I have done, I have just took a picture of this page and it is saved in my background. I will just show you where necessary. So we are doing equipment, which is equipment C, and we are calculating depreciation for equipment C. And equipment C's depreciation is for the year 2013. And the cost of equipment C is 25,000 rands. Remember, we are not given any residual values for these equipments. We only know that their depreciation is 10% on the straight line method. Therefore, now because of that, we can immediately times that by 10%. Therefore, now it means the depreciation for the full year will be 2,500 rands. But we only need it for a couple of months, which is how many months? Only 3 months, from May, June, July, because this asset was acquired on the 31st of April. So now we times that by 3 over 12 months. Let us see, 2,500 times by 3 over 12 will give us 625. 625. 2,500 times by 3 over 12, just confirm that. It gave us 625 rands. So now that is the depreciation for equipment C only for 3 months from May, June, and July. Then after, let us continue calculating depreciation for the old equipment, and the old equipment was sold at the end of the current accounting period. There, if you see that 30 dot, on the 31st of July 2013, old equipment which was in the business from the 1st of July, or sorry, from the 1st of August 2011, with a cost price of 95,000 rands, was sold on credit to Mr. C or Lecter for 50,000 rands. So now we have to account, remember, that first of all, with regard to this equipment, the opening accumulated depreciation for equipment, that opening accumulated depreciation being 9,500. That 9,500 is only for the old equipment, because depreciation for the new equipment was not yet accounted for. So now the rest of the old equipment was all disposed, indicating that 9,500 is only for the old equipment. So we don't have to go back and calculate all the depreciation for the sold equipment from the date it was acquired, because we already have it until the end of last year. Therefore, now we only have to account for the current year, then we move forward. So now we are doing depreciation for the current year for equipment, which is the old equipment. Let me not say equipment, let me just say old depreciation. Equipment depreciation for the old equipment. Let me write it like that. Old depreciation on equipment for the year 2013. The cost of the old equipment is 95,000 rands. We times that by 10%, that will give us 9,500 rands. So we know that this equipment was there until the end of the year. So now if it was there until the end of the year, we don't have to count for any number of months. So it is just perfect for us to leave it in that stage. So now we come to our ledger account. In our ledger account, we had two amounts. The first amount was 625 for the depreciation of equipment C, 625, and we added now the next depreciation that we just have calculated now, the one of 9,500 rands, which is the one there at the bottom, 9,500. We say 9,500. The reason why we add the two is because the old equipment was sold at the end of the year. So now it means both depreciation for the new equipment and the old equipment were recorded at the end of the year, because all the depreciations are recorded normally at the end of the accounting period, unless the asset was disposed during the accounting period. So now if you add the two amounts, it should give you 10,125 rands. Then you say 10,125 plus 9,500. That will give us an amount of 19,625 rands. Now remember, take this into account. Listen carefully. 9,500 is the accumulated depreciation for the old equipment, because the new equipment was just acquired during the current year, and we have calculated depreciation for that to be 625. Therefore, now there is no depreciation for any other equipment that is there in the opening balance except the old depreciation. So now that is total accumulated depreciation for the old equipment, and we have added depreciation for the current year for the old equipment that has been disposed now at the end of the current year. So now we have to take the total of 9,500, we add, so yeah, 9,500, and we add 9,500 of the depreciation that we have calculated in the current year, so that we remove it because this asset has been disposed. So now if it has been disposed, it must be removed from the credit side, and we only remove that through the debit side, because this asset, or this account, sorry, increases on the credit side and it decreases on the debit side. So now the total of 9,000 plus 9,000, which will be 9,500, just doing calculations, times by 2, will give us 19,000 rands. Therefore, now why are we debiting 19,000 rands? It's because equipment, the old equipment was disposed. Therefore, now we don't need its accumulated depreciation appearing in the books of the business. So now hence we debit that, and the contra entry will be asset disposal. Asset disposal. So now same applies under the asset, the ledger account for equipment. The contra entry was asset disposal with the amount of 95,000 rands, because this asset was disposed. So the contra entry became asset disposal. Therefore, now when we are removing the accumulated depreciation, once again we write asset disposal, because this asset was disposed by the end of the year. So now we can balance this ledger account, because there is no other depreciation to be recorded during the current accounting period. So now we have an amount of 19,625, and the balance carried down will be 625 rands, 625 rands, and that will be the balance brought down. And if you see the balance is only the one of 625 for the new equipment C, because the old equipment, which was costing 95,000 rands, was all sold. So now the minute it is sold, therefore now we must also remove the total accumulated depreciation until the date that asset was sold. And this asset, being the old equipment, was sold at the end of July in the year 2013. That is why now the balance at the end of the year becomes only the one of the depreciation for the new equipment that was acquired 3 months before the end of the current accounting period. So now that ledger account is completely done. We shall continue doing the last ledger account. And the last ledger account is the asset disposal account. Asset disposal ledger account. This ledger account we always record from the previous ledger accounts. Double entry rule still applies, it does not change. We say for every debit there must be a credit, or for every credit there must be a debit. In the equipment ledger account, if you see there, we have credited 95,000 rands, and the contra entry was asset disposal, which means that asset disposal must be debited by 95,000 rands. Contra entry must be that ledger account being equipment, or you can mention as old equipment. Then under the accumulated depreciation for equipment, we have debited 95,000 rands, or we have debited this ledger account by 95,000 rands, and the contra entry is asset disposal, where we were removing the total accumulated depreciation for the old disposed equipment. Therefore, now if that is debited in the accumulated depreciation, it must be credited in the asset disposal ledger account, and the contra entry will be accumulated depreciation on equipment. Just because of space, I'll just write accumulated dep. Then after we know that this old equipment was sold for an amount of 50,000 rands, and whenever something is sold and it was sold for cash, for credit, then that becomes debtors. Let us check. I think they told us that it was sold on credit to C Olecta. Yes, there we go. It agrees exactly with me. It was sold for 50,000 rands on credit to Mr. C Olecta. Therefore, now C Olecta becomes our debtor because he still owes us an amount of 50,000 rands for the sale of this asset. So now what other people will do in this ledger account at this time is just to strike the difference between the small and the bigger side, which is the easiest shortcut. We just check which side is greater, because now we have to determine if have we made a profit or a loss. 95,000 rands, 95,000 rands. Then after what you do, you say 95,000 rands minus 19,000 rands minus 50,000 rands. Then that will give us 26,000 rands. So now if the debit side is greater, therefore now the difference will go to the credit side as 26,000. Whenever the difference falls on the credit side, then you know that you made a loss on disposal of equipment. So now this loss of 26,000 rands will have to be recorded in the income statements under expenses, because making a loss is an expense to the business. So now let me just show you another approach where you can calculate the loss of on the disposal of an asset. Remember, this was the calculation, the last amount 19,500 was the calculation of the depreciation for the old equipment, and we have highlighted that the accumulated depreciation for the year 2012 was also 9,500. Let me just add 9.5. For the year 2012, we have also proven that the depreciation for this asset was 9,500 rands. So now if you add the two, it should give you 19,000 rands. We have already calculated that. So now what that tells us is that if we say cost price minus accumulated depreciation, that will give us the carrying amount. Then after we get to the carrying amount, we compare the carrying amount or the carrying value with the selling price. And if the carrying amount is less than the selling price, the difference becomes a loss. But if the carrying amount is above the selling price, the difference becomes a loss. But if the carrying amount is below the selling price, the difference becomes a profit. So now in this case, we have to calculate our carrying amount. Let me just rub there. Just calculating the carrying amount of the old equipment that was disposed. So we say carrying amount is equal to cost minus accumulated depreciation. The cost of the disposed equipment is 95,000 rands minus 19,000 rands, the one that we have just calculated. Then that should give us 95,000 rands minus 19,000 rands. That gave us 76,000 rands. So now this is the value of the equipment at the end of December or at the end of July in the year 2013. So now if this is the value, yet this equipment was sold being the selling price was 50,000 rands. It means it was sold at a price very below than its value, and the difference becomes 26,000 rands, which is the loss on the disposal of this equipment. So now another approach will be to calculate the loss like this, because not all the times you'll be required to do the ledger account, but you might be required to calculate if have you made a profit or a loss on the disposal of any particular asset. So now I have completed all the ledger accounts that were necessary. So now what I will be doing, I will be transferring the same information in all these three ledger accounts, including, don't forget, my motor vehicles. We had motor vehicles. So now I'll be recording every journal entry that was required as necessary in in the requirements. So now let me just go to another blank page where I can do the general journal. I will be doing general journal. And I know that general journal always has a debit side and a credit side. Preferably you can just draw a line in between, not necessary. Just draw a line in between. So now we have to start with the depreciation for all the vehicles that we had. So now we record depreciation for the first vehicle, and the contra entry will be accumulated depreciation for vehicles, and we calculated that to be 12,750 rands, and that will again be 12,750 rands. Let us check if did we really calculate that 12,750. Yes, there we had 12,750 in the ledger account. There you see 12,750 rands. That was the depreciation for the old vehicle. Just add a zero there because I incorrectly wrapped it. So now that is the first depreciation that we record. Then we record the second depreciation, which is still a depreciation on vehicles. Then we debit depreciation once again with an amount of 625, okay, 6,875. It was 6,875, 6,875 rands. Contra entry still becomes accumulated depreciation on vehicles. So now we have recorded depreciation for the new vehicle and for the old vehicle. Then after we come to the side of equipments. So now we record depreciation for the equipment, and the one that I still remember now is the depreciation for the year of the old equipment being 9,500. Contra entry is accumulated depreciation of 9,500. And if you see, what I'm doing is exactly in line with the ledger accounts. In the ledger account, accumulated depreciation ledger account is credited by 10,125, and that 10,125 is made of 625 and 9,500. So now either way, if you want, you can combine the two, you record one amount, 10,125, or you can record them separately as 625 and 9,500 separately. It's just that now it was not required for us to combine it. However, even if you combine it, it's not a problem because you will be recording from the ledger account. So now just separate the two, record 9.5 separately and record depreciation as 625 rands, 625 rands, and the contra entry will be accumulated depreciation. So now I have accounted for both depreciations for all the equipments, the one that was sold and the one that was bought during the year, the one that is still in the business. So now I have to record the disposal of this equipment. Remember, there was equipment that was disposed that was costing 95,000 rands. So now if you see, equipment is credited by 95,000 rands and asset disposal is debited by 95,000 rands. So now I do the same thing in the ledger account. I credit equipment because our equipments are assets. So whenever we sell our assets, they are decreasing, and they are decreasing on the credit side because it's an asset decrease on the credit side. So now I debit my asset disposal by an amount of 95,000 rands as it appear in the ledger account. Then after I credit equipment by 95,000 rands because our equipments are decreasing or going down by 95,000 rands. Then after I go to my ledger accounts and I say there was no other disposal of any equipment. Remember, with the motor vehicles, there was no any other disposal, and the purchase of the new vehicles was already recorded. Hence, I'm not going to record a journal entry for this 25,000 rands if you see this on the debit side, because this 25,000 rands was the new equipment that was purchased, and there was no mistake, it was recorded correctly. Now, the reason why I said I record it again, I just wanted you to show that anything that is acquired during the current year, it must be separated and it must not be included in the opening balance. That is why I did the ledger account, so that you see that these things are recorded separately, although it was already included in the opening balance as it was stated in the additional information. So now I'm done with the ledger account for equipment, and I am done with the ledger account for the depreciation. Therefore, now the only thing that I need to do now is to record this 19,000 rands. You see the asset disposal. Sorry for that. I have to record this 19,000 rands, the one on the debit side, and that debit side also appears on the credit side. So now even if I record that one or I record this, still does not make a difference. Remember, this has already been recorded for. So now hence I prefer to record it from the ledger account of the asset disposal. So now whenever you have a ledger account that has many items on one side, or one item or two or three items, just record all of them, then you take their total. If you see here, we have the credit side. Remember, credit side is always on the right hand side and debit side is always on the left hand side. So now this ledger account is credited, the asset disposal ledger account is credited by three entries: accumulated depreciation, debtors or data, and loss on disposal. It means we just have to credit asset disposal by all these items, and obviously we debit all these items and we credit asset disposal. So now we do that. Asset disposal is credited. That means we must credit asset disposal by the total of all these three. Therefore, now we debit all these three. So now we will be doing that in the general journal. We debit accumulated depreciation. There we go. We debit accumulated depreciation 19,000 rands. Accumulated depreciation 19,000 rands, and we debit a data by 50,000 rands. We debit loss on disposal by an amount of 26,000 rands, and we credit asset disposal by the total of the three, and the total of the three gave us 95,000 rands. So now that is just very straightforward. Then after we come to the next journal entry and we check if is there any other journal entry that is still left. The 95,000 rands of the cost of the asset was recorded. The accumulated depreciation has been recorded. The data 50,000 is recorded. The loss is recorded. And if this 90,000 is recorded, it means that 19,000 on the debit side of the accumulated depreciation is also recorded. So now we are done. 10,125 is recorded because we have separated that into 625 and 9,500, and 95,000 rands has been recorded. This was recorded. We don't have to do any journal entry with regard to that. So now that means we have recorded all the journal entries that affect only the assets in terms of vehicles and equipment. So now we must do the last journal entry where we were told that there was an interest that was not paid. Therefore, now any interest that is not paid, you debit interest expense and you credit accrued expense. Remember, accrued expense is an expense that is an interest expense that has not yet been accounted for. Accrued interest. And I think we calculated that to be 7,500. 7,500. Let us just check. In the trial balance, we had interest expense that was given to be 22,500, and they told us in the adjustments that this interest for 9 months. So now if we divide it by 9, it will give us 2,500 of the interest per month. Then I said times that by 3, it will give you 7,000 interest that is accrued for the next 3 months, because interest was supposed to be paid for a period of 12 months. So now hence we times that by 3. That means the accrued portion of the interest for 3 months will be 7,500 as I have indicated in the general entry. So now we have just completed the adjustments as it was required in the exercise. So now let us check if what is the next requirement or the next instruction. The next instruction says complete and close off the disposal of an asset in the ledger account, which is just out of 3 marks. I think we have already completed the asset disposal. We have just done that now. Here is the asset disposal. So now we have already done 1.2 and 1.1 is here. Here is 1.1. So now we can move forward to the next requirement. In the next requirement, we are required to complete the note, which is the property, plant, and equipment, the one that we normally call PPE note, property, plant, and equipment, in the statement of financial position as at 31st of July 2013. So now, answering this question, or in answer to this question, I will prefer that I just use the note that I've already completed before I did this exercise. So now I will just show you how to do the note. In fact, I've already done the skeleton of the note, so now we'll just work on what is already on the table. So now here is how your note must always look like. Here is how the note must be expected to look like. So now I've already written all the assets that are affected by the note. We do have land and building, we do have vehicles, we do have equipment. Then after, you have to record the total for all the 3 assets. So now we are dealing with 3 assets, and I will be doing the note for the 3 assets. Remember, we start with the land, and we were told that the cost of the land was 100,000 rands, and they told us that land does not depreciate, so now it remains the same 100,000 rands. There was no purchase of land during the year, there was no disposal, there was no depreciation. Therefore, the cost at the end of the year will remain 100,000 rands. Remember, land and building in this exercise is regarded as if it does not depreciate. Then at the end of the year, we'll have the carrying amount as the same 100,000 rands. When it comes to land and building, it is just always a giveaway marks. If you remember, once again, in the asset ledger account for vehicles, in the asset ledger account for vehicles, this is where we are. I will be just linking the two. I have shown you that Our vehicle's opening balance is an amount of 100,000 rands. We are in the column now for vehicles. This is where we are. Remember, don't be lost. We are doing the vehicle side. So now I will just be doing this through the workings that I've done, and I've recorded opening balance for my vehicles to be an amount of 100,000 rands, as you can see that. So now that was an opening balance, and it must still remain the same opening balance in the note. So now we record that as 100,000 rands for motor vehicles, and we were given the opening accumulated depreciation. Remember, this is on the first, just to write the 1st of August in the year 2012, beginning of the year. This is on the 1st of August in the year 2012. These are opening balances, and the opening balance for accumulated depreciation was recorded for the motor vehicles to be 15,000 rands. So now we take the 15,000 rands as it is. We don't change it because it is an opening balance. So now we do the same thing. Just wrap there and add the 0. So 15,000 rands is the opening balance for motor vehicles. We write that as an opening balance, 15,000 rands. So the carrying amount for motor vehicles will be 85,000 rands. Then we come to the heading of the movements. Under the movements, we have acquisition, which is purchases of assets. Purchase of vehicles during the year. Then we ask ourselves, was there any purchase of motor vehicles during the year? The answer is yes. We bought a new vehicle, which was vehicle costing an amount of 50,000 rands. Let us check in the ledger account. The ledger account, there was a vehicle that was bought during the year that was costing 50,000 rands, and they told us this cost was already included in the trial balance, and we removed that, if you still remember that. So now we have 50,000 rands. Disposal and carrying value, that means where we sold an asset, there was no selling of a motor vehicle. So now we put that as dash. Depreciation for the current year now for all the vehicles, the old vehicle and for the new vehicle. This is where we record total amounts that are already combined. So now if you look at the total depreciation for our vehicles, it was 19,625 rands. We record that as a combined amount because we have done all the workings. We only transfer the total amounts. Hence, it becomes easy to do ledger accounts when you are required to do the notes. Start with the ledger accounts, then you just transfer, you copy, and you paste the amounts. So now we write 19,625 as the depreciation for vehicle for the current year. 19,625. 19,625. Remember, this has to be negative because depreciation reduces the value of the assets. At the end of the year, we must have a cost of our vehicles. And now at the end of the year, that is the closing balance in the ledger account. In the ledger account, the closing balance for vehicles was 150,000 rands. There is the balance brought down. If you see there in the ledger account where I'm highlighting, balance brought down of 150,000 rands. After we said opening balance, see the opening balance, and we added 50,000 rands of the vehicle that was acquired during the year, that will give us 150,000 rands. Remember, there was no vehicle that was sold during the year. So now we just add the two, that will give us closing balance of motor vehicles as 150,000 rands as it appears in the ledger account. Then after we have the closing balance, remember this is balance on the 31st of July in the year 2013, and this is closing balance on the 31st of July in the year 2013. Just take note of that. So now this is also the closing balance of the vehicle accumulated depreciation at the end of the year. So now our vehicle's closing balance accumulated depreciation is an amount of 34,625 rands. 34,625. We write that 34,625 rands. So now if you strike the difference between the two and you say 150,000 rands, you subtract 34,625, that should give you 115,375 as your carrying amount of the motor vehicles at the end of this accounting period. Therefore, now we go to the last entry now, where we will be recording the cost, the movements, and the closing balance for all the equipments. And remember now, when it comes to the equipments, there was a disposal of the equipment during the year, and there was also a purchase of the equipment during the year. So now we have to account for both of that. So now we are under the column for equipment. Then let us check what is an opening balance for our equipment. Under our equipment, we have recorded an opening balance of 95,000 rands. So we record that as an opening balance again in the note, 95,000 rands. Then we record 9,500 as an opening balance of the accumulated depreciation. If you remember, that was given to be 9,500. So now we just record that as it is. So now just to check, if is it 9.5? Yes, under the accumulated depreciation, there we do have an opening balance of 9,500 under the accumulated depreciation. So that's where the 9.5 comes from, and it was already in the trial balance. So now if you say 95,000 rands minus 9,500, that will give us 85,500 rands as the carrying amount for equipment. Then after we come to the column for movements. In the column for movements, we say, okay, it's acquisitions, which is the acquisitions or purchases during the year. Did we buy any equipment during the year? The answer is yes. How much was the cost of that equipment? It was 25,000 rands. Make sure that this is positive because the value of the assets is going up, or the total of our assets is increasing by the amount of the purchase. So now hence that is a plus. Disposal carrying value, yes, we did dispose and we did sell the old equipment, and the carrying value for the old equipment was 76,000 rands, if my memory still serves me. Let me check if do I still have that. Yes, there we go. We said that the carrying amount is 76,000 rands. So now whenever we do the note, we record the disposal at carrying value being 76,000 rands. But don't forget to write 76,000 rand, which is the disposal, as negative. So we can do the same and show the negative in case these were there. So now 76,000 rands is the disposal of the old equipment that had a carrying value of 76,000 rands. Then we have to record depreciation for the current financial accounting period, and in the depreciation we record all the depreciations for all the equipment just in one. We combine all of them, the sold one and the one that was not sold by the end of the year. So now I think we have already calculated also that in our ledger account. In our ledger account, we had a total of the depreciation that amounted to 10,125 rands. So now you just record that as it is, as a total of the depreciation for all the equipments that we have in the business. So now we record that as 10,125 rands. Okay, let me just confirm that calculation, if is it accurate or not. Okay, there we go. So now let us continue recording the depreciation at the end of the year. So now this will be an amount of 10,125 rands being the depreciation for the current accounting period for all the equipment. And make sure that the depreciation is always negative. Don't let that change. Then after, we have the cost of the equipment at the end of the period. Cost of the equipment at the end of the period. Therefore now we do have that as how much was the cost. The cost is 25,000 rands at the end of the period. So now we record that as 25,000 rands. We record that as 25,000 rands. Then after, we record accumulated depreciation at the end of the period. I think it was 625. Accumulated depreciation at the end of the period, yes, it was 625 rands. So now we take that into account, 625 rands. So we record that. Then after, at the end of the period, we will have to record the carrying amount for this asset, which is at the end of the period. Then we have to say 25,000 rands minus 625. That gave us 24,375. That gave us 24,375 rands. So now we have the carrying amount for land and building, carrying amount for vehicles, and carrying amount for equipment. Then after, make sure that you write their total under the column for the totals. Let us just add the 2. If you add, or the 3, it will give us 295,000 rands. And add those, we get to 24,500. Make sure that still remains in brackets. That will be 270,500. Normally there will be a line, bold line there separating the two. Then after, we scroll and we calculate the next totals. Then we add 50,000 and 25,000 rands. That gave us 75,000 rands. That will be an amount of 76,000 rands. Negative, don't forget that. Then here we have to add the two, 19,625 plus 10,125. Then that will give us a total of negative 29,750 rands, because these amounts are all negative. Then we add 100,000, 150,000 and 25,000 rands. That will give us 275,000 rands. We add 34,625 and 625. That gives us 35,250 rands. Then we add the last part. That will give us 239,750 rands. So now this is the total of the carrying amount. This is your carrying amount. Carrying amount that will go to the statement of financial position under the property, plant and equipment line item under your non-current assets. So now we have just completed the note, which is a very important part when it comes to the asset disposal. And always this question will have big amount of marks. Make sure that you fully understand. Let me just show you everything as you can see. So now make sure that this is always done like this, and with that you will not go wrong. So now let me check if do I still have anything to do in this exercise. So now we were required to do the note, which was the last part. So now I come to the requirements. So now we've done 1.3, which was out of 11 marks. So now I will stop there for the day, and on my side I will say bye bye. Enjoy this lecture. Thank you.